So it is Monday, February 23, 2026. And I mean, if you're just glancing at your calendar, this week probably looks completely standard.
Right, just a normal week.
Yeah, but if you have any money in the market at all, and I literally mean even just a passive index fund sitting in your 401k, you really need to circle Wednesday, February 26 in bright red ink.
Oh, absolutely. It's definitely a hold your breath kind of moment for the entire financial world. We are staring down the barrel of a 24-hour window that could frankly either validate the entire last 3 years of economic history.
Or completely put a massive dent in the narrative we've all been living through.
Exactly.
Because we are talking, of course, about the AI gold rush. For the last 3 years, the whole stock market has essentially been fueled by this high-octane propellant called artificial intelligence. But looking at the sources we've gathered for today's deep dive, we've got investment analysis, market trend reports, specific S&P 500 data. The vibe has noticeably shifted.
It really has.
Yeah, it feels like investors are sort of standing around the gas pump wondering if the tank is actually running dry, which is our mission today. We need to figure out why this specific week is so critical.
That really is the central tension right now. Are we at the peak of this whole AI boom, or are we literally just getting started? And to answer that, we actually have to look at one company's homework assignment.
Right.
Essentially, you have one single corporation that is about to hand in a report card. And that report card dictates the grade for the entire tech sector.
Which honestly feels absurd when you say it out loud. The idea that the global economy is just sitting around waiting on one PDF to drop.
I know, but it's true.
But before we get into the whole philosophy of that, let's lay out the who and the how big.
Yeah.
We are talking about Nvidia. Now, most people know them. They make the chips. But the numbers in the analysis we're looking at they frankly just don't feel real.
No, they are staggering. Completely staggering. Let's look at the market cap provided in the source material. Nvidia is currently sitting at a $4.6 trillion valuation.
I just want to pause on that for a second because trillion is one of those words that totally loses its meaning when you say it too much. 4.6 trillion.
It's massive.
That is bigger than the entire GDP of Germany. It's bigger than the GDP of Japan. We are talking about a single company that is essentially the size of a G7 nation's entire economy.
And all that value is concentrated in a single CERM. But honestly, the number that actually scares financial analysts, or I guess excites them depending on what their position is the gross margin.
Right, the margin.
Yeah, the source lists NVIDIA's gross margin at approximately 70%, specifically 70.05%.
Let me just stop you there.
Yeah.
70% for hardware. That sounds almost predatory.
Yeah.
Because usually when you're making physical things, chips, boards, plastic, silicon, your margins are super tight. You're fighting for 10, maybe 20% profit if you're incredibly lucky. How do you get 70% profit on a physical object without regulators stepping in or your customers just completely revolting?
You do it by having absolutely no viable alternative. That margin speaks to what we call in finance a moat.
Like a castle moat.
Exactly. NVIDIA isn't just selling a chip. They are selling the only infrastructure that actually works for modern AI. It's like, imagine they built the only railroad tracks in the whole country, and they also happen to own the only trains that fit on those tracks.
Wow. Okay.
So if you want to move cargo, or in this case, if you want to move data, you have to pay their toll. That 70% margin is essentially a monopoly rent on the future of computing.
So they are basically charging software-level premium prices for a hardware product just because everyone is so desperate for it?
Precisely. And by the way, they're trading at around $189.67 a share right now.
Okay, so that leads directly into the fear that's mentioned in the source material. Why is everyone sweating so much about this particular earnings report? The sources say AI stocks have helped the S&P 500 soar in double digits for 3 years straight. If Nvidia is this insanely profitable, why stop the party now?
Because of the CapEx question.
Capital expenditure.
Right. The source explicitly mentions a shift in sentiment right now. For 3 years, investors were basically eager to pile in. It was a complete land grab.
Buy everything AI related.
Buy it all. But now they are much more cautious. The specific worry detailed in the analysis is that the pace of AI spending may slow at some point.
Let's translate that a bit for everyone. The spending they are talking about is coming from NVIDIA's own customers. So we're talking about Microsoft, Google, Meta, Amazon.
The hyperscalers.
Yeah, these companies are spending hundreds of billions of dollars buying these NVIDIA chips. So the fear is that they might look at their own balance sheets and say, hey, we aren't actually making enough money from AI to justify buying any more chips right now.
That is exactly it. It's the classic return on investment problem. You can only spend $50 billion a year on infrastructure for so long before your shareholders start tapping their watches and asking where the profit is from all this equipment. If those big tech companies decide to pause, I mean, even for just one quarter, to digest all the hardware they've already bought, Nvidia's revenue takes a huge hit. And because Nvidia is priced for perfection,
Price for perfection is such a scary place to be as a company. It basically means if you are merely good, you fail.
that's the danger. The source notes that if spending slows, these high-flying stocks could come crashing down. And crashing is the exact word the analysts used. It implies a violent correction, not just a gentle slope downwards.
So everyone in the market is tuning in to gauge the levels of demand. They need constant reassurance that the appetite for these chips is still insatiable.
Yes.
And this is why the source analysis calls Nvidia the bellwether.
Right. A bellwether historically is the sheep that leads the flock.
Yeah.
In financial terms, it indicates the direction of the whole broader market. But I actually think it's deeper than that here. Nvidia isn't just a signal. They are the actual bottleneck.
The bottleneck.
The source explains they sell the most powerful chips used for crucial AI tasks. And they specifically mention the training and inference of large language models.
Okay, I see those two terms thrown around constantly in tech news, training and inference. I feel like we really need to nail down exactly what those mean so we can understand NVIDIA's business model.
Sure, it's a great distinction to make. Think of training like going to medical school.
Okay.
It takes years. It costs an absolute fortune. It requires massive computing brain power, and you have to cram a huge amount of raw information into the system. You basically only do it once, or maybe once in a while, to create the doctor being the AI model itself.
Right, so that's the heavy lifting phase. That's OpenAI building GPT-4.
Exactly. But then inference is the doctor actually seeing patients in the clinic. Every single time you open ChatGPT and ask it a question and it generates an answer, that is inference. It's happening millions and millions of times a day globally.
And here is the kicker for NVIDIA's business. You need NVIDIA chips for the medical school part, and you also need NVIDIA chips for the hospital part.
That is exactly why the demand has been so incredibly durable. First, everyone bought chips to train the massive models. Now they need even more chips to run them as live products for everyday users.
Right.
So if Nvidia reports that inference demand is skyrocketing, it means AI isn't just an expensive science project anymore. It means it's an actual revenue-generating business.
Which would totally calm the fears about that return on investment problem we talked about earlier. If inference is high, it means regular people are actually using the tools.
It's the healthiest possible signal the market could get.
But the flip side of that is the ripple effect. If the market giant sees headwinds, the source says it spills over. And it's not just a tech industry problem, right?
No, not at all. And this is where you really need to pay attention as an investor or just an observer. The text explicitly notes that AI investment spills over into a wide variety of stocks.
Give me some examples.
Well, banks use AI for fraud detection now. Logistics companies use it for routing their fleets. The healthcare sector is using it heavily for drug discovery.
So it's everywhere.
It's everywhere. So if Nvidia comes out and says, hey, people are buying fewer chips, it's not just a localized tech issue. It signals that the entire global economy is pulling back on innovation and modernization.
So my personal portfolio might take a hit even if I don't own a single share of a semiconductor company?
Almost certainly. Look, the S&P 500 is weighted by market cap. Because Nvidia is a $4.6 trillion company, it makes up a massive percentage of the index itself.
Right.
If you own a generic S&P 500 index fund in your retirement account, you are heavily exposed to Nvidia, whether you actively picked it or not. Basically, if Nvidia sneezes, your 401k catches a cold.
That is a pretty sobering thought. Passive investing isn't really all that passive when the index is this heavily concentrated at the top.
Not at all.
But let's look at the actual evidence we have leading into this week. The source material asks a really great question. Are we just flying blind into this earnings report?
We aren't. We can actually read the tea leaves from the other players in the ecosystem.
Right, we have the prospectors and the rivals to look at. The source brings up advanced micro devices, so AMD and Microsoft.
Let's start with Microsoft. They are likely Nvidia's absolute biggest, or at least one of their biggest, customers globally, and they just recently reported their own earnings.
Right, and what did they say?
Well, they spoke of continued high demand from AI customers.
Which is huge. If the customer says we are still buying, that is a very good sign for the shopkeeper.
Exactly. And then look at AMD. They are Nvidia's closest rival in chip design. They also reported strong demand in their recent quarter.
So if the competitor is selling out of their inventory and the main customer is buying more,
Logic dictates that the market leader, Nvidia, is probably going to post a pretty massive number. The expert synthesis in the source suggests it is very likely Nvidia's message will be optimistic rather than a disappointment.
but here's where the psychology of the market kind of overrides pure logic. We talked earlier about being priced for perfection. Even if the numbers are objectively good, the narrative has to be absolutely perfect. And this brings us to what the sources call the Jensen Huang factor.
Ah, yes. The man in the leather jacket.
Yeah. The source specifically highlights that investors will be listening to, quote, every word from leader Jensen Huang. And it really has become a bit of a cult of personality with him, hasn't
Yeah,
it?
without a doubt.
Because earnings calls used to be these super dry affairs, just CFOs reading spreadsheets in a monotone voice. But a Jensen Huang call is basically like a rock concert for financial analysts.
He really has turned himself into the Steve Jobs of the AI era. And the market listens to him differently than other CEOs. They aren't just parsing the revenue column, they are analyzing his tone.
Right, like is he confident? Is he hesitating?
Exactly. It's all about the forward guidance.
Completely. The source notes his overall message will set the tone for the S&P 500's performance the next day. He needs to sell a story. He has to convince the entire world that the AI gold rush isn't just some 3-year bubble, but the start of a 10-year industrial revolution.
Yep. If he gets on that call and says, we see demand extending robustly into 2027 and 2028, the market likely rallies hard.
But if he gets on and says something like, well, we expect a slight normalization in the second half of the year, panic. Absolute panic.
Yeah, normalization is a very dirty word when you are trading at 70% margins and a $4.6 trillion valuation.
It is wild that so much global wealth rides on one man's choice of adjectives on a Tuesday night.
It really highlights the sheer fragility of the moment we're in.
Okay, so let's get really tactical with the timeline here, just so no one is confused. The source is very specific about how these dates roll out.
Right, let's clarify that. The actual event happens on Tuesday, February 25. But it happens after the market closes. That's when the financial PDF drops and the conference call with Jensen happens.
So you won't be able to trade on it unless you're doing something complex like trading futures until the next morning.
Correct. So Wednesday, February 26. That is what the source calls the huge day.
That is the day of impact.
Yes. That morning, when the opening bell actually rings in New York, we are going to see a massive move. It could be a 5% gap up. It could be a 10% crash down. But one thing is for sure, it won't be flat.
And as we established earlier, that move is going to drag the rest of the tech sector and the broader market right along with it.
Correct. The gravity is just too strong.
So bringing this all back to you listening to this deep dive right now, you might be a teacher or a dentist or a software developer. Why does this matter to you beyond just checking your retirement portfolio balance?
Because this earnings report is essentially a proxy for the global economy's confidence in the future. If Nvidia crushes it, it sends a signal that companies everywhere are still in growth mode.
They are investing.
Yes, they are investing, they are hiring people, they are building new tools. It keeps the broader recession fears at bay.
And if they miss expectations,
it validates the underlying fear that the economy is slowing down. If major tech companies stop spending on infrastructure, they usually start cutting costs elsewhere.
right.
We've seen brutal layoffs in tech before. A bad report here could trigger another wave. It literally changes the psychological weather for everyone, not just Wall Street.
It really highlights how integrated technology has become with the basic plumbing of the modern world. It's not just some side sector of the economy anymore.
Tech is the market. And right now, Nvidia is the beating heart of tech.
Okay, so the mission for you this week is simple. Don't ignore those news notifications on your phone this Wednesday morning. Even if you don't care about GPUs or large language models, the direction of that red or green arrow is going to tell you a lot about how the rest of 2026 is going to feel.
It's basically the ultimate economic pulse check.
But before we wrap up this deep dive, I want to leave you with a thought that's been sort of nagging me while we reviewed all these sources. We've marveled at the $4.6 trillion number. We've talked about the incredible 70% margin and the moat.
It is undeniably a marvel of modern engineering and business strategy.
It is, but it's also a little terrifying, isn't it? We are building what we proudly called the future of civilization, this entirely new digital intelligence layer, and it almost all funnels through a single company's supply chain.
It's the ultimate single point of failure.
Right. If AI is supposed to be the future of everything from healthcare to finance to national defense, why is that future currently entirely dependent on one company, one CEO, and one quarterly earnings report? Are we building a brand new digital civilization on a foundation that is incredibly narrow?
That is the multi-trillion-dollar question right there. If the indispensable monopoly somehow stumbles, is there a safety net? Or does the whole circus tent come down?
Definitely something to ask yourself while you watch the ticker tape on the morning of February 26. That's it for today's deep dive. We'll be watching the numbers right along with you.
Stay curious.